Recording. Well, good morning, everyone. Maggie Sanchez with Modern Broker, your chair for Education Committee. We are super excited to have our annual economic and housing update with the best, the one and only Jordan Levine. Thank you so much. Hopefully next year we'll have you in person.
Definitely.
So cross our fingers. So we are all interested and want to know that crystal ball that you have to let us know what's going to happen with these amazing interest rates in the market. So
Yeah, exactly.
I will let you take over. Just a few housekeeping rules. If you have any questions, either raise your hand or put it in the chat box, and then I will be going through the chat box. I don't know if you want me to monitor that, Jordan, or do you want to kind of go?
I'll try and keep an eye on it, but if you can help me out, that'd be great.
Awesome. So
Thanks.
I'll send it over to you, Jordan.
Thank you so much. I'm going to share my slides, and actually you guys are the guinea pigs because I just got back from vacation and seems like everything was, I was actually on a houseboat in Lake Shasta, so I had no reception or anything. And when I checked my phone on the way home on Monday, I was like, oh my gosh, the stock market, interest rates, the inflation number from Friday, and then now we just got new retail sales data. And so everything's been all over the map, and I've been up since 6, like frantically redoing my whole entire deck. Usually I can just like change like 25-30%, add the local data, and then everything is through, but it seems like everything has changed in the last week or two. So it was a good exercise for me to go through and just kind of collect my thoughts. I ask your forbearance because I haven't ran through this material before. But I think let me back up and just start by saying that I do think we're finally starting to see signs of a shift in the marketplace. Up until now, the market's been very strong. And if you follow our monthly or weekly releases, we've been noting that, right? Even with all of the challenges coming down the pike, the housing data had remained incredibly strong. The market was still very, very competitive. And that's still, for the most part, the case. But we are starting to see those initial signs, I think, that the second half of the year is going to be tougher. And that's important to note because I think we have a lot of big macro tests coming down the pike. When you look at closed sales, and I don't know if the press release has gone out, but we are releasing our sales report for May today, and that shows that we dipped to the lowest level of transactions since the pandemic started. So we've been maintaining about a 420,000 unit pace right up through April, but in May that dropped down to about a 375,000 or so unit pace. So that's not just below where we were last year. That's below where we were even at the onset of the pandemic. And that's the first time we've seen sales really kind of falter since the onset of the recovery. Things have just been incredibly strong. And when you look at the forward-looking data, right, it's important to keep in mind that most people report on closed sales. Closed sales are the result of what's been happening over the last 45 days or so, right? People were rate locked, people were, in escrow, and this is the kind of culmination of all of those things. Looking forward, it's really all about the pendings and the active listings, right? And when you look at those numbers, it suggests that we have more belt tightening coming down the pike at us, right? That probably this 15-year high that we had for transactions last year will continue to moderate down, particularly in light of these rising rates. And I think rates are probably poised to continue to go up. We have inflation that, again, as if you go back to the April one, the number came down a little bit and people said, yes, we're finally past peak inflation and maybe the Fed won't have to be as aggressive. Fast forward to last Friday and things popped back up, right? So we went to another 40-year high for inflation, even with these higher interest rates. And lo and behold, we saw the Fed come out guns blazing yesterday with a 75 basis point rate hike, which is the biggest they've done in almost 30 years, right? So they are laser focused on inflation, and that means probably higher rates. And I think that leads to more macroeconomic exposure, right? And I think that probably consumers are the biggest risk to our economy, and consumers is you and me, right? So we have a challenge to be able to keep spending going in the face of these rising prices, and especially on things like cars and other things that you take loans out on, with rates having gone up so much. And I think that's particularly true in light of a stock market that has been very volatile. I think the Dow dipped below 30,000 this morning for the first time in a very long time as well. So not only are we paying more for all of our goods and services, folks with stock portfolios are now poorer as well. And so that will have a kind of compound impact just on, consumer sentiment, which is down, and all of those things. So how is this all going to affect us in housing? Well, I don't think that even with an economic recession that it means a big foreclosure crisis and a plunge in home prices. We had much better fundamentals coming into this cycle, right? And we had a lot of folks putting money down on their homes. We had a lot of underwriting that was in the 720 plus FICO score range for conventional mortgages. And so we don't have that same kind of ticking time bomb level of systemic risk bubbling under the surface of these home prices. And I don't think we'll probably see a major sell-off where a bunch of sellers start to cash in, right? Because folks have equity in their homes, because they put money down, because for the most part, the economy has largely recovered. I don't think you're going to see the sell-off the way that you had when we had all of those kind of 5-1 option arm ninja loans pervading the mortgage market that created this underlying incentive for people to throw their keys back to the bank. So I don't think we're going to see that. That being said, housing prices have really decoupled from the fundamentals, right? That they can't just be explained by low rates and incomes anymore, the way that they could even as recently as the beginning of last year. And so even as housing, I think, isn't poised for a major REO crisis, I do think that we could see the market dry up and stay at low levels of transactions, and maybe even some softness in prices as we get into next year. And so when you put it all together and think about what does it mean for me as an individual realtor, what does it mean for what I tell my clients moving forward, I think that it's important to keep in mind that even as there's a kind of shift afoot, as it were, shifts actually mean new opportunities, right? There's going to be a lot more opportunities for those buyers who've gotten buyer fatigue to get into the market, both in terms of an increase in options, right? And active listings are finally going up for the first time in basically 2 years. And that means that, folks who still want housing have a better chance now than they've had in a while. It also makes sense to buy before rates go any higher, as they're projected to do. And so even as there's kind of macroeconomic uncertainty, there's still a lot of good reasons for buyers to stick with it. And I think that they might have more opportunities than they've had in the last several years, to be sure. And even as that is true, I think it's still a great time to sell, right? We're seeing market competitiveness come down. We're seeing more active listings, and yet homes are still selling pretty quick outside of the standards of anything other than the last, year and a half, when we've been in this kind of feeding frenzy for houses. And I think that's even more true, that it's a good time to sell if you're going to turn around and become a buyer and take out a new mortgage, right? Because you also want to benefit from rates before they get up into the 6.5-7% range. So that's the kind of overview, and I'll kind of bury you with the bad news first, and then we'll progress on to the kind of rays of optimism that I have. But again, we did see the first signs of cracks in the market, and our May numbers showed that sales went down to about 378,000 units, which is a almost 15.5% decline from the rate of sales that we were posting at the same time last year. It's also the first time we've been under 400,000 transactions since the onset of the pandemic. So part of us expected a reduction, right? We were expecting negative growth rates this year because, again, last year was a 15-year high for transactions, but now we've actually started to dip below those pre-pandemic levels for the first time. And the declines were pretty broad-based, both geographically, as you can see here with, my hometown of SLO and the Central Coast leading the charge, and with a 22% decline. But you can see that we had sales go down across the board, including in the Central Valley, which was down by 12.5%. So, that is something that I think is noteworthy, because it's not just the kind of San Franciscos of the world moderating back down from 15-year highs. This is a pretty broad-based slowdown across the entire state. And I think it makes sense in the face of the rising rates and what it does to purchasing power. It was also broad-based, across price segment, including stuff from 750 upwards of 2 million, which those homes have been really leading the charge. And actually the reason why California hit such highs last year was because everything above 750 was growing by double digits. Now you can see that growth has really been whittled down to just occurring in that very highest price segment of 2 million and up. And I think that when the top end of the market slows, it kind of takes away a big piece of the growth mix that we had here in California thus far. And I think that folks taking out $2 million mortgages are price sensitive, as it were, when it comes to interest rates. The good news is we're kind of outperforming the rest of the state locally. So this is the first 5 months of the year in transactions compared to the first 5 months of the year last year. And you can see that we're, for the most part, maintaining, a better rate of growth. Tulare proper is down 3%, but even that is less than what you saw in the rest of the state countywide. We're still running 5% ahead of last year, with pretty good growth across the board, including in Visalia, which is the one of the bigger markets. And so even as we've seen the transactions start to falter, what's really interesting is that the prices have not skipped a beat, right? And part of this is because we still are selling more homes at the top end of the market in that 2 million and up range, but we now have a statewide median price that is in the $900,000 range, right? Which is more than double what it is in Tulare County. And actually prices are still going up by 10%. Again, keep in mind, these are closed transactions. And so, this is the function of folks who were getting in while the getting was good, when rates were still at 3.5%, 4.5% about 40 to 60 days ago. And that created this surge of buyer demand. That sense of urgency, I think, that over the short run has caused prices to continue to grow that at basically a double digit pace. You can see the median price in the local market are also have grown considerably. This is the May 2022 median price that just went out this morning, or will go out soon. And prices are obviously much higher than they were a few years ago. But what's really interesting is here too, prices are growing by, for the most part, double digits across the board, right? Across the entire county. And so we still have this kind of excess demand environment. It's just not keeping the foot on the gas as much as it was in terms of closed sales prior to the increase in rates. And so that's the closed stuff, right? But if you look at the forward-looking data that tells us what's going to happen in July and August and throughout the rest of the summer, it suggests that we should kind of, keep a nose to the grindstone mentality, because the numbers suggest further softening coming down the pike. First and foremost on that front is the biggest decline in pending transactions since the pandemic started, right? So pendings, which tell us what's going to happen with June sales, or maybe even July, we're down 30%. And pending, did a fairly decent job of predicting the 15% decline in closed sales that we had in May, right? The other thing is that mortgage applications, which have been falling from 2020 and 2021 levels for months, are now falling even below those pre-pandemic levels themselves. So it's kind of matching what we're seeing in our pending sales data, that folks are not filing applications to get into the mortgage market at the same clip that they were when rates were 2.5% to 3%. That has led to an increase partially in active listings, right? The fact that we're not churning through those homes as quickly, we're not selling them as fast as we were a few months ago, means that we've now seen active listings rise to the highest level they've been at since the start of the pandemic as well. You can see also they're still depressed by the standards of even 2018 and 19, which were terrible years for inventory. But the kind of the lack of velocity in terms of transactions means that we're carrying more active listings forward into each month than we have been in the past. And actually active listings were up by almost 50% from where they were at this time last year. And so this is where I say that, it's a sign of a shift, to be sure, but it's also an opportunity for buyers who've gotten buyer fatigue and are just sitting on the sidelines and sick of putting in offers. I think that, there's going to be opportunities, and you're going to find sellers that are more motivated now than they have been in quite some time. Part of it is also new listings, right? So what I was showing you before was total actives and how many are actually on the market at any one time available for sale. This is how many we're throwing onto the MLS every month. And you can see that we're also putting more homes into inventory, right? So it's not just that we're not selling them as fast, we're also putting more on, but nothing to suggest a major sell-off yet either, right? We're basically in the same territory that we were in terms of folks selling homes back in 2019, but it is, a significant increase from where we were last winter, right? When we were basically putting on 10,000 units statewide a month, which was just nowhere near what we needed to maintain the level of transactions. So part of the inventory increase is that we're not selling as fast. Part of it is that sellers are starting to sell again, and I think motivated to get into that next home before rates do get any higher. And I think that's what you're seeing there. If you put the two numbers together, right, closed transactions and the new listings, the new inventory being added to MLS, you could see that we had both an increase in transactions at the onset or a little bit after the pandemic began. That yellow line actually went up a bit from where it was in 18 and 19. And at the same time, sellers basically pressed pause on selling their homes, right? There was this huge gap that opened up between the number of homes that we were selling off of the MLS every month and how much we were putting back on every month to replenish that kind of drawdown of inventory. And that's what led to this incredibly competitive market environment, was just that we were clearing out our shelves and we weren't getting any new deliveries of goods to put back on there. And you ended up getting, 70-80% of the homes selling above ask price, 7-day median time on market, and all of the crazy competitiveness that we've seen over the last couple of years. You could see with that increase in new supply coming online, we've started to close that gap. And actually, I created this new metric called market velocity, which is just the percentage difference between those two indicators, right? How big is the gap on a percentage basis between this yellow line, which is sales, and the blue bars, which is new listings? And you can see both in California and in Tulare, at the onset of the crisis, we had that increase in sales met right up against this kind of decline in the amount of inventory showing up on the MLS. And that market velocity number went up to about 400%, meaning that we were selling 4 times more homes, than we were putting back onto the MLS every month, leading to that kind of constant erosion in the number of actives that I just showed you over the course of the last couple of years. Well, if you fast forward to May of 2022, and even in April to a lesser extent, you could see that market velocity has started to come down, right? Sales have backed off a bit, new listings have crept up a bit, and so we don't have that kind of 400% market velocity. And I didn't overlay prices onto this, but price growth really mirrors what we see on this market velocity number very closely. When there's a lot of homes selling and nothing coming on the market, prices go up. It makes sense intuitively, but actually, if I plotted it out for you, your inner data nerd would also be satisfied that this is a fairly predictive indicator, which suggests that even as we set new all-time high prices, that we'll probably start to see prices take a bit of a breather, at least not growing by the 10 to 15% that we continued to see in May. One of the things that tells me that is that the percentage of homes that are closing, and this is out of our weekly MLS data, and I don't know, this is a plug, I guess, for our weekly market reports that we put out, where we both give you a big data book, a chart book, but also give you a one-page write-up. But we've been seeing this coming for the last 8 weeks, right? That the percentage of homes closing above list price has been backing down fairly consistently from 75% roughly down to less than 2/3. We're still seeing 63% of homes close above list, but actually this peaked early, right? Usually this peaks in June, July. these peaked back in April and have started to come down. So that kind of pressure valve on the housing market has started to release a little bit, again, because that market velocity is slowing. We have less sales, more inventory for buyers to choose from. Here too is an area where Tulare County's bucking the trend, right? Because unlike the rest of the state, where the percent of homes closing above list price is going down. Oh, and I don't have my legend on here, but the blue stuff is what's going on through the first 5 months of 2022, and the green is through the first 5 months of 2021. But you can see, for the most part, actually for the entirety of the county, there's still more homes selling above list this year than there was last year. So again, this is an area where we're outperforming, and I think, both because we're so much more affordable than that $900,000 median price, because remote work is alive and well, and because we have that renewed passion for home ownership, it's kind of keeping markets like Tulare County propped up longer than what you see in the rest of the state, even as I think we'll eventually succumb to the broader macroeconomic trends. We are still kind of punching above our weight relative to the rest of the state. But in the rest of the state, you can see that homes are staying on the market longer too. So if you look at median time on market, it's still very low for closed transactions that we report in our monthly press release. But look at the days on market on the left, right? Those are homes that are still active, not homes that have closed. And you can see that there, we've basically doubled the time on market for remaining actives, right? So the surviving listings are having a harder time selling. And again, we're at a higher level of days on market now in May than we were back last winter in kind of December, January timeframe. And I think that's why, even as closed prices are growing by 9-10% statewide, what you see is that listing prices are starting to come down, right? That is a good leading indicator of close. You can see that when there's a spike in the dark blue, then about 6 to 12 months later, you get a spike in the light blue, and vice versa, right? When listing prices go up, then eventually close prices go up. When listing prices start to ease off, we can expect that close prices will start to ease as well. And you can see that's already been underway since mid-2021, when they were growing by about 35%. We can expect price growth to continue to soften as buyer demand dwindles and we get more inventory for the remaining buyers to choose from. So that's kind of a recap of what's been happening the last couple of weeks in the housing market. And I want to throw that up against the kind of broader economic context, right? Because on Friday, we got the CPI number, which is, the primary measure of inflation that the Fed looks at. And you can see, even after it eased a bit in April, it shot right back up in May. And so we had a core inflation rate on a year-over-year basis of 8% and an overall inflation number of 12% on a year-to-year basis. And this has got the Fed's, back against the wall, essentially, to get this under control, right? Because you can see here in the retail sales, which we just got, I believe, on Monday, that sales are basically leveling off. They actually went up a little bit. If you look on the left-hand side and really squint at that chart, you can see that retail sales are actually a little bit higher over the last couple of months than they were in the first quarter. But you can see the pace of growth in retail sales has really slowed. In fact, in May, we only had a 7% increase, right? And so through the lens of inflation that was increasing by 8 to 12%, right? In real terms, spending is actually going down, right? We're not able to keep pace with the increase in these prices. And that has implications for us for the macro economy, right? Because if you look at how that spending has been maintained, it hasn't been through rising wages and incomes, right? We've actually been able to keep pace with inflation because we're kind of drawing down savings that have been built up over the course of the last couple of years and running up consumer credit in the form of both auto loans and credit cards. And for me, that's concerning from a kind of broader macroeconomic standpoint, because those aren't sustainable levels of growth, right? You can only run savings down to 0%. You can only run up the credit cards so high before they become maxed out. And the reason why that matters, and actually that's before we even take into account the stock market volatility, right? And I wanted to show you this first, because this is the value of the stock market. It's the market cap of the Wilshire 5000. So it's the market cap of all publicly traded companies in the United States, divided by the amount of earnings that those companies are generating in the economy. And this is only through the first quarter, but you can see that the valuations on the stock market are not backed up by how much money these companies are making. There's a gap that has opened up, and this kind of gray band is like plus or minus 1.5 standard deviations. That line, that market cap, the valuation of the stock market is usually 7 to 10 times, 7 to 11 times what companies are earning in the U.S. economy. Right now it's 17 times, and that's even after some volatility in the first quarter. So I think we have more stock market volatility ahead of us, and that's kind of the 1-2 punch, right? Because not only are your income not keeping up with the increase in the cost of haircuts and gas and groceries and everything else, but now you're also poor as well, because the financial market is probably poised to come down a little bit more. And the reason why I'm stressing on consumers so much isn't just to kind of justify my student loan, right? Inflation, consumers, and all these esoteric macroeconomic concepts. But if you look at the economy, consumer spending is still 70+% of our economy, right? And so we're very exposed to consumers, both good and bad. When they're spending lots of money, it's great for economic growth. But when they pull back, it takes a lot of growth in these other categories to make up for a consumer-led pullback. But it's not just that they're 70% of the economy. If you look at the recovery in 2021, the increase in GDP, the economy expanded by about 6% last year as we recovered from the pandemic in 2020. But if you look at how that's divided out across the various segments of our economy, you can see that basically the entirety of the recovery has been driven by consumer spending, right? The 5.3% of the 5.7% economic growth that we got was from consumers. That's like in the 90% range. So there's 70% of every dollar that gets spent in the US economy, but they're 90% of the growth that we've been experiencing. And so again, if folks can't keep up with their level of spending and they become poor, it leaves us pretty exposed to an economic recession, because we have most of our eggs in this one basket of consumer spending and people buying stuff on Amazon and buying new cars and finally going out on vacation and all of that stuff. And so, there is a level of exposure there. And then on top of that, we're going to layer in higher interest rates, right? So this is the dot plot on the right-hand side of the federal governors, reserve governors' opinions of where rates should be coming out of yesterday's meeting. And you can see that these are kind of, each dot is a Federal Reserve Board governor, and it's measuring where they think the Fed funds rate needs to be at the end of 2022, end of 23, and the end of 2024. And they've increased this substantially. As of the meeting in the first quarter, the expectation for the end of 2022 was in the 2.5% range. Now, most of them think it should be in excess of 3%, probably somewhere in the 3.5% range, and potentially rising even higher than that next year to 3.6, or 3.7%. That's why they had such an aggressive 75 basis point increase last week. And I think, a lot of the Fed's behavior has already been priced into the market, right? So it's not that they're going to continue to raise the Fed funds rate by another 200 basis points, and all of that is going to show up in mortgage rates. You could see that, even after the Fed had only increased that very first 25 basis point increase that they did earlier this year, mortgage rates and 10-year Treasury rates had already increased. They shot up basically 200 basis points overnight. So I think a lot of it is priced in, but it's probably not all the way priced in, right? And so a 5.8% Freddie Mac mortgage rate number from last week is still a good number when you compare that looking forward. And I think that's something that we need to get buyers focused on, right? Not whether there's going to be volatility over the next couple of years, but you have options now. Rates are going to be higher down the road. If you're buying a home that you can afford, it makes sense to do so, at 5.8 compared to 6 or 7.5%, because I think that when you do a simple thought experiment of where rates are going in the future, you could look back at where we were before the crisis, right? And rates are really kind of fairly easy to explain. You have a Fed funds rate, you have a yield curve, which is the difference between the 2-year treasury and the 10-year, and then you have a mortgage rate spread, right? And so if you go back to the beginning of this year, we had about a 25 basis point Fed funds rate. We had a 100 basis point yield curve, right? The 10-year was about 100 basis points higher than the 2-year. And we had a mortgage rate spread that was basically dead on historical average at 170 basis points, giving us that 3% mortgage rate. Well, if you just do that same thought experiment and apply it to the dot plot that I just showed you, we can get a sense of where rates are headed in the future. Because if they take that Fed funds rate up to 3% and we maintain a 100 basis point yield curve and we have that same historic average spread on mortgages, we're looking at probably a best case scenario entering 2023 of a 6% mortgage rate. And that's probably a best case, right? If you look back at that dot plot and you look at how persistent the inflation's been, I do think there's a chance that they'll end up having to be even more aggressive than what they're broadcasting. And you may see that dot plot continue to get revised higher. And if we have a 4% federal funds rate, right, and 100 basis point yield curve, and they continue to kind of sell off their mortgage-backed securities, we could see a bigger mortgage rate spread as well, meaning that we could be looking at 7.5% mortgage rates as we get into 2023. And I think that should be a huge motivating factor, but I also think it's creating a lot of macroeconomic risk, right? Because it makes a lot more sense to buy at 6 than 7.5%, because that has huge impacts on purchasing power. What I'm showing you here is a new interactive tool that we just added to our website, where you can actually go in and see the effect on purchasing power of changes in interest rates. And what I'm showing you here is, for a hypothetical buyer in Tulare County who's making, whose household is making 100 grand a year and wants to put 20% down and have a relatively low debt to income ratio. Well, at 3%, that family is targeting a monthly mortgage payment of $2,500 a month. At 3%, that means that family could afford a $552,000 home in Tulare County. And we know that, and actually I didn't update this through May. I didn't have a chance to update this, apologies. So this is only through April, but that family had 245 active listings on the Tulare County MLS that were at or below that price cutoff. Well, what happened to that family as rates have now climbed up near 6%? Well, to get that same $2,500 a month mortgage payment, you're looking at a price now of just $420,000. So you've lost $130,000 of purchasing power, but you've also lost significant market exposure as well. It's not just that you can afford less, there's fewer options out there at these low price points. Well, what happens if rates do go up to that worst case scenario? Now you're looking at an even bigger erosion, another $50,000 of purchasing power lost, and even fewer active listings coming in under that price point. And so again, I think this should be a great motivator for buyers who have gotten, buyer fatigue to stick with it. But I also think it's why we can expect the market to continue to cool, right? Because you can't just absorb the extra $150,000 without taking that monthly mortgage payment higher or putting down significantly more money, right? And so again, I think that that's why we can expect the market to continue to moderate. I also think that the increase in rates, again, creates more macroeconomic risk. You probably can't see it very well on this chart, but the yellow line, which is the 2-year bond, has crossed over the 10-year note. It just did so again this week, right? And this is what the econ nerds call a yield curve inversion. It is basically one of the only economic indicators that has a 100% success rate in terms of predicting recession. And what it really means is that there's a lot of short run risk in the economy, right? That when you have to pay a higher interest rate on a 2-year note than you do to somebody on a 10-year note, it means that people don't want the 2-year note, right? And you've got to pay higher interest rates or reduce the price of that 2-year note just to get the market going. And that is usually symptomatic of an economy where at least the financial market is very concerned about short run risk. And if you map this out historically, every time the yellow has crossed the green for a sustained period of time, a recession has followed. And so I do think that's a very real risk for the next 12 to 18 months that, we're going to kind of get inflation in check at the cost of the broader economy, right? Because the Fed is really trying to walk that tightrope and get the spending and inflationary pressure under control, but they're generating a lot of short run risk for consumers, you know, in the process. And so even as we don't think housing is going to be the thing that takes the whole economy down, right? We aren't exposed to that major REO crisis that we had back in 2008, 9, and 10. I do think that housing has some exposure. If you look at the median home price now of almost $900,000 in California, it's now more than 10 times what the median household in California actually earns, right? And so eventually we're going to have to pay for these homes. It's not, you know, as bad as it looks on the surface, but these price to income ratios are double the historical average and in that kind of danger zone level that they were at back in 2006 when things did start to fall apart. You have to, of course, account for mortgage rates, right? Because it's not just the price of the home, it's what it costs you to make that monthly mortgage payment. But even there, if you look at the monthly mortgage payment on that $900,000 median priced home, it consumes almost 75% of gross income, right? Leaving just about 25% left over for food and gas and taxes and utilities and all of that other stuff, insurance and what have you. That's not a sustainable number, right? We do have, again, much better fundamentals. And actually, this is one of my favorite charts. But if you look at everybody who stopped making mortgage payments during the forbearance period, right, and during the height of the pandemic, it's encouraging that we're not on the brink of another foreclosure crisis, because about 20% of everybody who went into and subsequently got kicked out of forbearance never even missed a monthly mortgage payment. You have 12% about who missed mortgage payments but already caught up, right? So they're not, you know, in the red, as it were, anymore. You had about 1% amortized missed payments into their loan, not much to worry about there. But you had almost 30%, and this is a really encouraging number, that actually took their missed payments and just moved them all the way to the end of the loan. This shows that banks got on board with homeowners this time, instead of saying, hey, you know, volatile economy, that's your problem. That which created the incentive for folks to say, oh, you think I'm on my own, you're on your own. And they would foreclose and throw the keys back to the bank. Banks worked with homeowners this time and moved a lot of payments to the end. So there's no 15, 18-month balloon payments where you got to come up with 20 grand just to stay in your home. You know, you assuming you got your job back, and most people in California have, you just continue making an extra set of 12 payments in 2052 or whatever it is. Not a lot of systemic risk there. You had a lot of folks modify their loan. So they spread that loan, including the missed payments, out over a new 30-year term, oftentimes at incredibly low interest rates. A lot of these people who got into trouble now have lower mortgage payments today than they had moving forward, and don't have any outstanding balance. 7% are people who really got in trouble but had home equity. And so they were able to sell the home, pay off the loan, and maybe even pocket some money to kind of bridge through to better times. It was less than 17 or 18% of about 8% of the mortgage market that just has no plan, right? 85-ish% of people represent no systemic risk of major REO. So that doesn't mean zero foreclosures, but it probably means foreclosure inventory that's like in the 1 to 2% range, not the 60, 70, 80% range that we had back in 2008, 9, and 10, when you know, the REO was the only comp we had, and it became this self-fulfilling prophecy that just brought all other prices down, and the appraisals and comps and all of that stuff. It just started this kind of snowball effect towards the 60% price reductions that we had. And actually, California is doing better than the rest of the nation on this, right? We have more of our mortgages current than basically every other state in the nation. We have less than 4% delinquency rate, and especially in that kind of 90 plus serious delinquency category. So it's not 0% delinquent, right? But it's not this kind of flood of foreclosures that's going to bring prices all the way down, and even as prices may soften a little bit. I do think that the shift means more opportunities. And again, if you look at the actives, not the closed, but the actives that are still on the market, more of the sellers are willing to make deals, right? We've seen an increase in the percentage of homes that are still actives that are reducing price, right? So not only do buyers have more opportunities, right? There's just more choices than they've seen on the market at any one time in the last 2 years, but you also have sellers who may be more motivated than they've been in quite a long time. We still see that renewed passion for homeownership. I don't have the 2022 number for you yet, but the percentage of first-time buyers getting into the market is still high, right? So we still have that going for us. And I think that we can use this to kind of successfully navigate. The benefits of home ownership are certainly alive and well. When you look at net worth in the United States, the typical family has $121,000 worth of net worth as of the latest Fed survey. But if you break that down between owners and renters, you start to understand why home ownership has been such a winning proposition. And this is where we got to get folks focused. It's, you buy for the long term at rates that are lower than they're going to be in the next couple of years, and you hold it for a long time and accumulate that wealth, because home ownership is still the one and only way that households and families in this country have earned wealth. I won't get too mushy, but I'll just note that I'm, the son of a high school dropout, and I wouldn't be here doing the speech today but for him buying his own house in the early 1980s. That really kind of set things up, and that's where people should be focused, not on what's happening to Bitcoin over the next 4 months or what have you. It's the long-term benefits of home ownership, which, as you can see here, are still alive and well. Renters still have no wealth, and that's been true for the last 4 decades. It's also still a great time to sell. Even as I talked about the percentage of homes closing above asking coming down from 75% to now just 63%, you're basically still talking about 2 out of 3 homes closing above ask, right? It's just not as incredibly competitive as it was, but it's still way more competitive than it was in the pre-pandemic era. So you're still going to be able to sell that home. You just probably got to price it right and stay keyed in on the fact that you're going to be able to lock in a better rate on your next home. Still, even on days on market, right? Active listings have a 25-day median time currently, right? That's their vintage. They're about 25 days old on average for the remaining actives. That seems large in the context of 8-day median time on markets, right? But when my dad was a realtor in the 80s, they would have killed for 25-day median time on market, right? So homes are still selling quickly. It's just we've gotten spoiled with 8-day, list to pendings, and that is starting to go away just because everybody can't absorb these big mortgage rates. The last thing I'll note is just that the economy has made incredible progress. We'll get new employment data for May tomorrow, but even through April, we had already added back more than 2.5 million jobs statewide, including in Tulare County, which actually was already fully recovered and 3% above pre-pandemic levels of employment. So that's the dominating factor that I think will also hold up, right? That the fact that we're starting to get past the pandemic, people can go out to eat, they can go, on a houseboat at Lake Shasta for a week and forget about what's happening with interest rates and all that stuff. And that will dominate the economy, at least to some level, even as folks struggle to keep pace with rising inflation and increased interest rates. California still outperforms the rest of the United States. So don't let anybody, foist a California obituary on you yet. We're still, in one of the top 5 fastest growing states in the nation for jobs. Our problem isn't our economy, it's our housing market and our housing supply, right? That's the only thing that's holding us back. So when you put it all together, I'll just kind of reiterate what I said at the beginning, that yes, we're seeing signs of a shift in the marketplace, and I think that we'll continue to see the market soften, but we're softening from a level that was unprecedented, right, in the last 15 years in terms of sales, market competitiveness, how fast homes were actually selling, and all of the kind of one-time shock factors of the pandemic. And we've got a lot of economic tests ahead of us that we're going to have to weather. And so I think, on the one hand, our clients are going to need us more than ever. But on the other hand, we're going to have to work for it really hard too, and stay on our game expertise wise, and showing them the data, showing them those counter arguments, the benefits of home ownership, where rates are going in the future, why it's still a good time to buy, why it's still a good time to sell and get into that forever home while the getting's good with interest rates, because I think that the market will be volatile and we will see how home sales decelerate. I think we'll probably see prices come down a little bit, but more so, I think that you're going to see the market dry up a little bit. You don't have these kind of incentives there for folks to do the big fire sale sell-off or REO throw the keys back to the bank that's going to drive prices down by 30, 40, 50%. But I do think that the market will be more volatile as consumers adapt. And so I think that, again, it comes back to refocusing the client on what really matters, the long-term benefits, the fact that rates are going to continue to go up, the fact that as a buyer, you have more chance now than you've had in a very long time. And as a seller, it makes all the sense in the world to kind of make that move again before rates get into the 6.5%, 7% range, because over 30 years, that difference will really add up significantly. So the market is normalizing. It's becoming more balanced, and we're kind of subsiding from this big feeding frenzy. We're not on the precipice, but we are going to have to really work for it in 2022 and especially in 2023, because we revised our sales projection for this year to be down by about 15% almost from where we were, which means about where we were in May. 370, 380,000 unit pace. We were expecting about a 400,000 unit pace just a few months ago. We actually revised prices higher for this year because we think that initial rush into the market as rates started to rise have still led to that kind of 10 to 15% price growth. But that will eventually subside as we get into 2023, and we'll see those prices become a lot softer. So I know I've gone on, and I appreciate you bearing with me. It was a little bit clunky because it was my first time through the deck this way, but I so appreciate the opportunity, Wendy and Maggie, and I appreciate the opportunity to speak to you as well, and for all your time and attention. Thanks so much.
Thank you, Jordan. Great forecast. So no foreclosure, guys. We're all expecting the 2008. It ain't happening.
It's not 2008 all over again. I know we're all going to be going to barbecues, and your brother-in-law is going to be telling you to just wait for the 40% price drops and all of that stuff. That I don't think is going to happen, but it is true that we have a lot of challenges ahead of us as well. So
awesome. Does anybody have any questions? I don't see anything. Given more workers are working remotely now, what are your thoughts regarding commercial, Silicon Valley, San Francisco, San Jose, LA, and how will this impact the rest of the state and Central Valley?
Great question. Yeah, I'm so happy that I work for the realtors and not like CBRE right now or something like that, right? Or Lee and Associates or whatever your favorite commercial, because I do think that commercial's got a longer road to hoe than residential. There's been this renewed passion for homeownership that's driving this kind of disproportionate, residential. We had a counter-cyclical residential market the last couple of years. The economy was in the tank, right? But housing, it did better than ever. I think that the commercial side is going to continue to face impacts, a lot of which we haven't seen yet. Folks are locked into long-term leases on commercial space, 3, 4, 5-year leases, more sometimes. And so I don't think we've seen the full extent of what that means. I can tell you just anecdotally, and I don't know how many of you all are kind of actively engaged with C.A.R., but we're debating what to do with our commercial space, right? Because we've had this kind of multi-year long task force process where we thought about redeveloping, thought about, all of these different things, and our needs have changed so much that I don't even know what's going to happen with our own building or where my office is going to be in the next couple of years, or if we'll even have an office, right? And so I do think that the office market is going to be challenged. I also think it's an opportunity. I actually wrote a white paper last year trying to lobby the federal government to give us a tax credit to convert commercial space into residential. What a perfect opportunity to turn a challenge into a big W in terms of alleviating the kind of strain on one sector while simultaneously kind of fulfilling our greatest need in the state, which is creating more housing. So they haven't responded yet, but it is a conversation point. But I do think that the commercial market will continue to be challenged, right? Because I think all of those decisions are still playing themselves out amongst employers. And Luis, I will send a copy of this deck over to Wendy right after this, and we'll also post it on CAR.org so you can use this to have those conversations. I would also, highly recommend go to our website, because I have that interest rate effect where you can have that conversation with buyers, and you slide around and put the income income right where it is and show it how it affects their purchasing power and get them motivated to buy. We have a lot of very localized data on Tulare County. If you want, stuff on Visalia or Tulare or Exeter or whatever, those are great ways to overcome objections. And, because people always say, that's great, I saw this article in the paper, and you could go, oh, well, look what's happening right here in Visalia in May with days on market, right? We're actually still growing. Prices went up more than they did everywhere else. I think that's going to be your friend. That's what I mean by navigating the challenges, is they're going to be reading all kinds of crazy stuff on the newspaper. You got to bring them back down to earth with what really matters and get them focused on the fundamentals.
Awesome. Any other questions?
I beat you all into submission.
Well, thanks everyone for attending. Jordan, thank you for your time and your expertise. We appreciate you, being here with us, and hopefully next show we'll have you in person.
100%. Look forward to it. Thank you all so much.
Thanks,
Thank
everyone.
you.
Have a great weekend. Happy Father's Day to everyone.